first. Can I begin by asking whether you think if we got more diversity into retail banking, we would raise standards in banking?
Pick that up? Okay. Well, I think that a good way of answering that question is to consider the difference perhaps between competition and choice. They're not necessarily the same. I think the diversity of banking institutions which are able to focus on different segments of the economy, different customer segments, different sorts of customers, different in geographical areas, different industries, different sorts of clients, and focus particularly on those areas, give an additional genuine choice to potential customers. That exists if you that doesn't exist if you simply have a series of very similar banks competing, which is effectively the situation we have had for some while in the UK. We have, by international standards, a remarkably homogenous banking industry, very concentrated, large national players, very few local banks, if any. And they all tend to prioritise chasing the same customers. And that leaves large areas, I would suggest, of the economy. Well, large. It remains to be quantified what the gap is, but it definitely leaves areas of the economy, sections of society, and geographical areas underserved.
Okay, so was that answer yes, because the homogeneity in banking will be broken down by the greater diversity that will come with this new type of banking?
Yes.
Is there anybody who disagrees with that?
I don't disagree, but I could make a point in addition, which is that I think one of the things that new entrants bring is almost an obsession on value, in other words, to try and provide a different kind of value to consumers. And the homogeneity speaks to providing a service that's very consistent. And I think that the innovation, if you like, in trying to provide different kinds of value to consumers is ultimately good for consumers. I think the homogeneity of the structure also tends to lead to some sort of herding behaviour, which isn't always in consumers' interests. So you can see that at one level by some of the more famous mis-selling scandals recently. But even in our case, where we are not trying to compete across banking as a whole, but in a narrow area, there are certain practices, I think, that you could argue were anti-competitive, which are helped by the similarity and the lack of numbers of the players exhibiting those anti-competitive behaviours. And I can sort of elaborate further if that's helpful.
Well, maybe we'll get an opportunity.
So my business, Zopa, is a peer-to-peer lending business that I agree is typically serving the same customers that would be served by banks. So we believe we're a direct competitor to what they do. And therefore, to finish your question, therefore could be a driver of change in their behaviour.
Pass on, and that's Giles. You mentioned the whole area of innovation very early on. I mean, could you just give us a sense of what your view would be of innovation within the traditional banking sector and what your sector is bringing to the picture here?
So the way we've chosen to innovate, so Zopa was the world's first peer-to-peer lending business. So we connect people who want to save money and allow them to lend it to people who want to borrow. And we've taken a very small part of banking. So banks provide a very wide range of services, from current accounts to credit cards, and even investment banking products, as Martin Taylor was explaining. And we've said, actually, there's a small part of banking which is simply making a loan for a fixed period of time, probably 3, 4, 5 years, and matching that maturity and repayment profile against someone else who's looking to make a saving. And by doing that and eliminating the entire sort of treasury function of banks and the matching of maturities and lending long and borrowing short and the kind of things that, for example, got Northern Rock into trouble, you've reduced an enormous amount of complexity from a bank and reduced it to an incredibly simple, easy to understand thing. And by doing that, you can strip out a lot of the people and the costs and the risk. So if you lend only in matched maturities, you're taking away a fundamental risk in banking. That allows us to offer better value to consumers. So we've innovated by cutting things out rather than by doing anything, because lending and borrowing is hardly an innovative activity in and of itself.
I have a few questions I'd like to ask about peer-to-peer lending, but I'm hoping Mark Garnier is going to get them in first.
Thank you, Trevor. Giles Andrews, can I carry on about that? Because I'm very interested to sort of learn more specifically about the peer-to-peer lending market. So at the moment you're doing private customer to private customer, is that right?
Yes, we are. And we're in the process of launching a small business arm, if you like, by focusing initially on sole traders. So sole traders actually behave mostly like private consumers. So the fundamental
credit
credit
more
risk.
sort of micro businesses as we would.
Yeah, I mean, there are 3.5 million sole traders in this country, ranging from plumbers to window cleaners to hairdressers to barristers.
I mean, typically, what are your... I'm just trying to get a sort of flavour of how it works. So typically, what size would a lender be, and what size would a borrower be? And are you matching a lender to a borrower? Or are you pooling these loans?
So it's very hard to describe a typical lender because they vary from people lending £10, which is the least, and our biggest lender is lending just under £1 million. On the borrower side, and the average is about £5,000. The average loan, coincidentally, is also about £5,000. But you can borrow up to £15,000. So it's an unsecured loan, so it's typically to buy a car or a kitchen or something like that. And on the pooling side, we have direct relationships between lenders and borrowers over very small amounts of money. So as a lender, we divide your total lending into units typically of £10. Mm-hmm. So you don't lend into a pool. So there's no sort of pooling or collection, if you like, of risk. You have direct risk exposure, but you have it to a number of different borrowers.
So what it essentially means is a little bit of your loan could default on you.
Absolutely.
But it would only be a small part. You're not taking 100% bet on one individual.
No, typically you're lending to at least 200 or 300 different people, which allows us at least to provide accurate predictions. So the overall level of credit losses isn't reduced by our diversification, but it at least enables us to say, well, if everyone's lending to 200, 300, 400 different borrowers, then we can provide very accurate information around what level of risk you as an individual are taking, and therefore how you can price that risk.
Yeah. No, that makes complete sense. How do you assess the borrowers in terms of, because of course one thing a bank would do is that they would assess a borrower's ability to repay the loan. How does that work with your... So
we use many of the same techniques. So we buy credit data from the same people that they buy it from. We buy it actually from Equifax and from Call Credit, but Experian is another name. And we put them through our own internally generated sort of risk models and scorecards, algorithms. But we also introduced from the very beginning a much more human side to what we do. So we speak. There was a great fad in banking in the 90s and pre-credit crisis. The consultants were saying banks should automate everything, computers make better credit decisions than people do. And banks have stripped out an enormous amount of their human side, which actually is particularly relevant in the SME sector, I think, because banks are actually unable to make human decisions to lend. When actually humans make the best decisions to lend to SME, someone goes and kicks tires or counts parts in a warehouse. So we've reintroduced quite a lot of that, which is actually very economic for us to do at scale, and involves a simple phone call where we can actually establish, we think better than any algorithm can, what that person's likelihood of repaying is. I mean, it starts with identifying them very thoroughly. But our underwriters are very highly trained in terms of asking questions about the use of the funds and things like that.
When you come to your business lending, again, have you sort of got an idea of what the typical loan would be, and have you got an idea of what the typical what your limit will be on an unsecured?
Well, we're going to start out doing the same as we do now.
Okay.
So we're starting out trying to use...
So you'll be lending instead of to an individual to something with
I mean, we already lend to sole traders, but we don't lend to them for their business.
No,
so if a window cleaner says, I want to buy a new kitchen, we would evaluate them in terms of stability based on how successful and long they've been self-employed for. But the actual loan purpose is not connected with the business. There is an additional risk. If you lend to someone for a business business purpose as well, you're introducing further risk. So we want to tread gently and grow that side of the business slowly, and we'll start as close to what we do now as possible.
What sort of potential size is there of this market? And I'm just kind of interested in terms of how big, what it is you and your sort of associates, if you like, are doing in terms of value of the market so far, and where you think it's potentially getting to.
Well, if we deal with the consumer side firstly, we believe the market's about £19 billion of new lending done each year.
19 billion?
19 billion. We have just achieved sort of in the region of 1% of that.
That's you alone?
Yeah, that's alone. So peer-to-peer as a whole is probably 1.5% of consumer lending. And we've done that without any advertising or promotion, so no one's ever heard of us, including, I suspect, some of the members of this committee before this session.
We're on telly now. So
no, but I think that represents the opportunity that given we believe that we have at least as good, if not a better product, there's no reason why we couldn't take significant share from the incumbents, because five players have got the other 99%.
I appreciate that. Now, question about competition, because the one thing the banks don't like is competition coming in, and presumably it wouldn't take much from the banks to snuff out what you're doing if they suddenly decided they wanted to have a go at you. Have you had any thoughts about that?
Well, it's difficult. It's the classic sort of,
but
it's a classic disruptive technology. What does an incumbent do faced with a disruptive entrant? Because to compete with a disruptive entrant, they have to discount their pricing significantly across the board. They can't just compete with the customers that might otherwise go to the disruptive entrant. So that actually the most sensible thing often for them to do is ignore it, because it might go away. So the sort of classic behaviour, look at this from people building railways to the big competitive industry fights you've had over the last hundreds of years. Typically the incumbents don't respond because it's uneconomic for them to do so until such a point when they have to respond, by which time they've lost some momentum. And sometimes the switches... I'm sorry?
They still have very, very big balance sheets. I mean, 19 billion lending per year, actually. When you think...
But the beauty of the model is the balance sheet is completely irrelevant. So Zopa has no balance sheet. It has no need of a balance sheet.
But the point is they do. I mean, if they wanted to whack... I mean, let's say you had 50% of that 19 billion lending market, so 8 billion, right? My math's not very good, 9.5 billion. I mean, by the time you look at the four big banks, I mean, combined...
But if we're offering 2 or 3% better value...
Then
they'd have to offer 2 or 3% better value across their entire personal lending book, which would have an impact on their P&L of many hundreds of millions. And their shareholders wouldn't thank them in the short term. And it's unlikely they would do it.
One other risk to your model is the regulatory side of things. And I don't mean this in any sort of disparaging way, but inevitably there's going to be a little bit of a scandal at some point. Someone's going to pick something up and start putting it across the red tops and all the rest of it. And that may lead to a regulatory backlash, it may lead to a reputational backlash as well. What are your thoughts about regulation and the potential of something happening which may cause you a problem?
Well, we've really confused regulators for about 3 years now, because we've been calling for regulation for our sector for just those reasons. So out of fear of something going wrong in the future and there being some sort of a backlash either at consumer level, because there's it's been captured in the press, or at regulatory level that they react too fast to something that's happened. So we've been saying we believe there are certain parts of our business that it will be helpful to regulate. So we formed a trade association.
Are you regulated at all?
No, we're not.
At all?
We have a consumer credit licence from the OFT, but we're not regulated for any of our lending activities by the FSA. And
do you want to be?
We are seeking, and there was a government announcement just before Christmas that the government is planning in 2014 to regulate peer-to-peer lending. So we've got a big job to make sure that regulation is fair and appropriate and proportionate and doesn't kill the innovation. But there's no reason why it should. The only reason a regulator would damage our business is if they tried to assume we were doing something we weren't. So we don't take deposits, so we don't need to be regulated as a deposit taker. We don't manage investment, so we don't need to be managed as an investment manager. So there are certain things, however, we hold client money. We need to lend responsibly. We need to have credit policies that are consistent and transparent. We need to talk to customers fairly. None of those things should damage our business. If anything, a sort of regulatory seal may help us build trust and grow faster.
Yeah. Sorry, your trade association?
Yes.
Remind me the name, so I should know.
Well, it's called the Peer-to-Peer Finance Association. It currently has 3 members: Zopa, Funding Circle, and Rate Setter.
And presumably together you're working together to sort of try and work out a regulatory framework that you would want.
So we've come up with one.
Yeah.
You know, we abide by a set of principles and operating standards, and we've politely told the regulator what they are, and I'm sure they won't adopt them wholesale. But it's a sort of start of a 10, yeah.
Yeah. Just out of interest, have you had many people come forward with to your three-man association with a view to starting up this? Is this an area that there's a lot of interest in terms of potential newcomers coming to the market?
Yes, so it's a business where people are launching businesses, so certainly quarterly, if not, I wouldn't say monthly, but I don't know if that's a feeling shared by other witnesses, but there's a lot of activity in the sector.
You wanted to have a last point.
I'll try and be as brief as I can. So one is as I see it, a market failure in the savings market that speaks to banking standards. So the bulk of savers' money is kept at very, very low interest rates. And that's a result of inertia in the savings market and the lack of transparency around banks who offer incentives to recruit customers and then don't tell them that savings rates have fallen from the 3% they promised when they joined to 0.1%, as I found out about my children's savings account very recently. And I think that an obligation on banks to inform their customers that promotional events have ended would be very good for competition or very good for consumers. That's my first point. My second point is around how a business such as Zopa is actually disincentivised from doing the kind of lending we've just spent a long time talking about because of a perverse tax treatment. So if I can just explain, if Zopa lends currently in a very prime world where there are very, very low credit losses, our lenders have to pay tax on the interest they receive gross. So if a lender lends money at 7% and suffers a 0.5% credit loss and makes a net 6.5%, he pays tax on 7%, and then suffers his credit loss afterwards. And the fact that he's suffered a credit loss after tax doesn't really matter. If you then move that into a world of more inclusive lending, which economically we simply can't do because of this tax incentive. If we were to lend money at 15% with an expected credit loss of 8%, the lender would suffer, would pay tax on the gross amount of 15%. A reasonably high proportion of our lenders are higher rate taxpayers, so they would pay tax at 6%. They would then suffer the credit losses, predicted credit losses of say 7 or 8, and they'd be left with nothing. So the tax incentive, which is in statute, and we're talking to the Treasury, as you might imagine, about trying to amend it, is very clear that because they're private individuals earning interest, they have to pay tax on the gross amount. They're not allowed to offset reasonable expenses against that, and a credit loss is a pretty reasonable expense to offset against an income stream. So until that's changed, a business like ours will never be able to make inclusive lending into disadvantaged areas. And we have a huge amount of interest in doing so from our lenders, and it just makes no sense for them to do so.
Well, I think that's a